Welcome to the world of candlestick patterns. In a single candlestick pattern, identifying a trading opportunity only requires one candlestick. However, as we delve into multiple candlestick patterns, the complexity increases, necessitating 2 or sometimes 3 candlesticks to spot a potential trade. This implies that the evolution of a trading opportunity spans a minimum of 2 trading sessions. Today, let's explore the engulfing pattern, one of the initial multiple candlestick patterns. The engulfing pattern unfolds over 2 trading sessions. Typically, it features a small candle on day 1 and a relatively long candle on day 2, creating the impression of engulfing the first day's candle. When this pattern emerges at the bottom of a trend, it's known as the bullish engulfing pattern. Conversely, if it appears at the top end of a trend, it's termed the bearish engulfing pattern. Today, let's explore the bullish engulfing pattern, a 2-candlestick formation signaling a potential reversal at the bottom of a downtrend. As the name implies, this is a bullish pattern, indicating an opportunity for traders to go long. The pattern unfolds over 2 days, and let's go over its prerequisites and the thought process behind it. Firstly, the prior trend must be a downtrend. The first day of the pattern should feature a red candle, affirming the bearish trend. On the second day, we need a blue candle, long enough to engulf the red candle from the previous day. Here's the thought process. The market is in a downtrend, steadily moving down. On P1, the market opens low, making a new low and forming a red candle. On P2, the stock opens near the closing prices of P1, attempting to make a new low. However, a sudden buying interest at this low point drives prices higher than the previous day's open, forming a blue candle. Bulls make a sudden and strong attempt to break the bearish trend successfully, surprising the bears and causing some nervousness among them. The bullish momentum is expected to continue in the next few trading sessions. For the trade setup, the suggested buy price is around the close price of the blue candle on P2. The risk taker initiates the trade on P2 itself after ensuring P2 engulfs P1. The risk-averse initiates the trade on the next day, confirming it forms a blue candle. If the day after P2 is a red candle day, the risk-averse trader ignores the trade, following Rule 1 of candlesticks. The stop loss is set at the lowest low between P1 and P2. Remember, once the trade is initiated, patience is key. Wait until the target is hit or the stop loss is breached. Trailing the stop loss to lock in profits is a strategy you can consider. Let's analyze DLF's chart featuring a bullish engulfing pattern. This pattern, encapsulated in the chart, presents an opportunity for traders. Now, let's delve into the specifics of this trade setup. On P1, with an open of 163, high of 168, low of 158.5, and close of 160, we witnessed a bearish day. P2, however, displayed a significant shift with an open of 159.5, high of 170.2, low of 159, and close of 169. For the risk taker, going long on P2 at 169 is the move. To validate P2 as an engulfing pattern, 2 conditions must be met. The current market price at 3:20 p.m. on P2 should be higher than P1's open. The open on P2 should be equal to or lower than P1's close. On the other hand, the risk-averse trader would initiate the trade on the day after P2, confirming it's a blue candle day. Typically, this would be Wednesday if P1 falls on a Monday. However, considering the dynamics of trading multiple candlestick patterns, it may be beneficial to initiate the trade on pattern completion day itself, P2. Regardless of the approach, both the risk-averse and the risk-taker would have found profitability in this example. The stop loss for this trade is set at the lowest low between P1 and P2, which, in this case, is at 158.5. Remember, executing the trade with precision and adhering to your strategy is key to navigating the market successfully. Let's examine a compelling example of a perfect bullish engulfing pattern on Cipla Limited in this scenario. The risk-averse trader might have overlooked a significant trading opportunity. There's often debate around whether the engulfing candle should cover just the real body or the entire candle, including the lower and upper shadows. From my personal experience, as long as the real bodies are engulfed, I find it acceptable to classify it as a bullish engulfing pattern. While some candlestick enthusiasts might contest this approach, what truly matters is how effectively you refine your trading skills with a specific candlestick pattern. Remember, trading is as much an art as it is a science, and finding a method that aligns with your style and yields consistent results is key to navigating the complexities of the financial markets. Let's delve into the bearish engulfing pattern, a two-candlestick formation that emerges at the pinnacle of an uptrend, signaling a bearish market sentiment. The logic behind this pattern mirrors the bullish engulfing pattern, but from a shorting perspective. Examining the chart, observe the two candles constituting the bearish engulfing pattern. Here's what unfolds. Initially, the bulls dominate, propelling prices higher. On P1, as anticipated, the market climbs, establishing a new high and reinforcing the bullish trend. Come P2, the market opens higher, aiming for another high. However, unexpected selling pressure emerges at this peak, unsettling the bulls. The ensuing sell-off drives prices below the prior day's open, instigating unease among the bullish investors. The robust selling on P2 suggests that the bears might have successfully breached the bull's stronghold, potentially paving the way for continued selling pressure. To capitalize on the anticipated downward slide in prices, the trade setup unfolds as follows. The bearish engulfing pattern signals a short trade. The risk-taker enters the trade on the same day after validating two conditions. The open on P2 is higher than P1's close. The current market price at 3:20 p.m. on P2 is lower than P1's open. If these conditions are met, it indicates a bearish engulfing pattern. The risk-averse enters the trade on the day after P2, ensuring it is a red candle day. Given that the bearish engulfing pattern spans 2 days, it may be more suitable for risk takers, although this choice depends on individual risk appetite. Let's analyze the chart of Ambuja Cements, where two bearish engulfing patterns have emerged. The first pattern, encircled on the left, didn't favor the risk taker, but the risk-averse would have wisely avoided the trade. However, the second bearish engulfing pattern proved profitable for both risk-takers and risk-averse traders. Examining the OHLC data for the second bearish engulfing pattern at the top end of the chart. P1, open, 214, high, 220, low, 213.3, close, 218.75. P2, open, 220, high, 221, low, 207.3, close, 209.4. The trade setup for the short trade, based on the bearish engulfing pattern, unfolds as follows. By 3:20 p.m. on P2, the risk-taker initiates the short trade at 209 after confirming that P1 and P2 together form a bearish engulfing pattern. The risk-averse enters the trade the day after P2, ensuring it's a red candle day. The stop loss in both cases is set at the highest high of P1 and P2, which in this instance is at 221. Remarkably, both risk-takers and risk-averse traders would have reaped profits in this specific scenario. Let's delve into a fascinating chart, a type that, from my personal experience, holds high profit potential. Missing out on such trading opportunities could be a regrettable oversight. Examining the chart, a few key elements grab our attention. An evident uptrend, clearly highlighted. A bearish engulfing pattern occurring right at the peak of the upward rally. Subsequently, a dodgy formation on the day following P2. Now, let's dissect this chart event by event. The prolonged uptrend confirms the dominance of the bulls in the market. On P1, a blue candle reinforces the bullish control. Moving to P2, the market opens higher, making a new high and momentarily comforting the bulls. However, a strong selling surge ensues, closing prices below P1's opening, instigating some panic among the bulls. On day 3, although the opening is weak, it's not significantly lower than P2's close. This lack of strength unnerves the bulls, and during P3, despite attempts to move higher, the day closes flat, forming a doji, a sign of indecision in the market. Bulls exhibited panic on P2 and uncertainty on P3, creating a scenario ripe for catastrophe, as evidenced by the long red candle following the doji. Drawing from personal trading experience, whenever a doji follows a recognizable candlestick pattern, the ensuing opportunity tends to be substantial. This analysis methodology extends beyond merely observing P1 or P2. It involves combining different patterns to formulate a comprehensive market view. Let's explore the piercing pattern, a close cousin to the bullish engulfing pattern, but with a subtle difference. While in a bullish engulfing pattern, P2's blue candle completely engulfs P1's red candle. In a piercing pattern, P2's blue candle partially engulfs P1's red candle. The crucial distinction lies in the degree of engulfing, which should be between 50% and less than 100%. This can be confirmed visually or calculated. Consider, for instance, if P1's range is 12. P2's range should be at least 6 or higher, but below 12. Once this condition is met, the remaining aspects align with the bullish engulfing pattern, including the trade setup. A risk-taker would initiate the trade on P2 around the close, while the risk-averse would enter the trade the day after P2, ensuring the formation of a blue candle. The stop loss would be set at the low of the pattern. In this chart, P2's blue candle engulfs just under 50% of P1's red candle. Consequently, we do not categorize this as a piercing pattern. The dark cloud cover closely resembles the bearish engulfing pattern with a slight difference. While the red candle on P2 engulfs P1's blue candle in a bearish engulfing pattern, the dark cloud cover entails the red candle on P2 engulfing approximately 50 to 100% of P1's blue candle. The trade setup aligns with that of the bearish engulfing pattern. Conceptualize the dark cloud cover as the inverse of a piercing pattern. Thank you for watching this video. If you have any doubts or questions related to trading, feel free to reach out to us on WhatsApp at this number. And if you haven't subscribed to our channel yet, please consider subscribing. We'll be back soon with another insightful trading lesson. Until then, have a wonderful day.